Anyhow, so welcome back. Uh, Again, I'm Carl Falstick, along with Dave Doney, one of your co-leads on the fiscal and economic issues, primarily focused on what's happening on the national level. And this is our September meeting, where we help you understand what the facts are and get, facts to use in your arguments, communicating to your audience, whether it be discussing with people in person, commenting on articles in the David's case, the New York Times, in my case, the Washington Post or something like that, as well as your Facebook posts and trying to get the right information out there. We're going to talk about the labor market, deficits and debt, inflation and wages, a few other economic statistics and action. Decent job month, job growth is slowing down. We added 187,000 jobs in August, but the two prior months job growth was revised down by 110,000. This number of total payroll jobs went up by about 77,000 versus what was reported last month. These are payroll jobs, so this includes everyone's on a payroll. It does not include your Lyft and Uber driver and whoever's delivering your Grubhub or McDonald's meals or whatever. Because typically those are 1099 workers and not payroll employees. The job creation under Biden has been good. And once we got back to the pre-pandemic peak, we got back to record jobs levels beginning in June 22nd, June of 2022. And we've added another 4 million jobs since then, adding at about 286,000 per month. So we're still making good progress on jobs, but it is slowing down. As we see here, that the last 3 months, the average has been 150,000, which is good. Don't get me wrong, especially when we talk about how many jobs we have right now. And some of what the job losses in the last, we've got the Yellow Trucking Company bankruptcy, which caused 37,000 workers to lose their jobs. We've got 17,000 workers in motion picture and sound out on strike. So there's some one-time things that are occurring that makes these job totals a little bit less now. Hopefully the GM strike doesn't become a big issue. We can get back to where we're adding 150 to 200,000 jobs a month.
Truth to the claim that we're shifting a greater share of these salaried jobs into the public sector instead of the private sector, or has that remained pretty stable?
I had not heard that. We could do a quick look right now if you want to, or we can.
I'm curious, or either we could do it next month too. I'm just curious how to respond when I hear such claims.
Well, bring it up at the end of the meeting, and we'll go do a quick look at the Bureau.
That's fine. Yeah, that's fair, because I don't want to distract everybody here.
Yeah, but anyhow, looking at job growth, Obama's second term, we averaged 216,000 jobs added per month. Trump pre-pandemic, we averaged 182,000 jobs. For all 4 Trump years, we averaged a net loss of 56,000 jobs a month. We did lose jobs during the Trump administration, the first time that had happened since the Herbert Hoover years of the Great Depression. And Biden, from inauguration, we've averaged 434,000 jobs. And since we got back to the pre-pandemic peak, we've averaged 286,000 jobs. So we've had pretty good job growth. We talk about the fact, whether I don't know where we do it in this, that 10 of the last 11 recessions started under Republican presidents. Since we started keeping unemployment statistics back around the 1930s, the unemployment rate has gone up under every Republican president except Ronald Reagan, and it's gone down under every Democratic president. But, Republicans are better for the economy. The unemployment rates did tick up this month. We went from 3.5 to 3.8% for the U3, which is the normally reported unemployment rate. Again, the U3 is people who aren't working during the month, looked for work during the month, where the U6 is people who weren't working during the month and looked for work anytime in the last year, or they are working part-time and want full-time employment. Okay, got a question. Are gig job companies seeing enough workers? Basically, as we'll get to a slide here in a moment, companies are looking for workers at all levels. Are we only adding low-wage jobs? The answer to that is no, although we are. If you remember back when we lost jobs back in the Great Depression or the pandemic, a lot of the jobs we lost were service jobs, waitresses, bartenders, hotel clerks, lower wage workers. It's why average wages went up. And as those workers would come back, the wages for the bartenders, waitresses, etc., have gone up from what they were, but they are lower wage jobs that are coming online, along with higher wage jobs. And so what we're seeing is that average wages are still going up. And David commented that government employment is still below where it was in 2019. Okay, so when I talk about the fact the unemployment rate went up 0.3% from 3.5 to 3.8%, we look at the Y, the number of people employed went up by 222,000. But what happened was we had a whole bunch of people who came into the workforce for whatever reason, whether it's they perceive great opportunities, which there are, or it's a quirk of these school calendars as to when people are coming in and getting out of the labor force, such that this number won't be as high in September. But we'll see what happens. But in any case, having a whole bunch of people coming into the workforce, 222,000 people getting jobs. Yes, the number of people unemployed went up and the unemployment rate went up, but it's, that's not for a bad reason. Employment for population ratio for prime age workers, 25 to 54, was 80.9%, which is a little higher than it ever was under Trump prior to the pandemic. So people are back into the workforce. They're not sitting on the sideline, by and large. I don't know if Keith's son is still in his basement playing video games, but that's a different story.
And this is a statistic that the Trump administration has picked up. They were tweeting it out today that the number of prime age workers is the highest ratio it's ever been. So they're using that stat, which is a good one.
And this is job openings to the unemployed. We've got job openings here. Well, here's job openings, number of unemployed, and the ratio of job openings to unemployed is well above 1. So there's about 1.5 job openings for every unemployed person, which means that most people should be able to find work, provided they're not locked out because of skills, or they're not locked out because of geography. I don't know what the situation is in West Virginia, for instance, or some of the states that have higher unemployment rates. And again, Illinois has a higher unemployment rate. We talked about the fact that that's because we have a whole bunch of people, a larger percentage of our population wants to work and is in the labor force.
So if you're an expert West Virginia coal miner, it's probably a less great economy than a lot of other fields.
You're probably not going to be able to find a job in coal mining very many places, but depending upon what other skills you've got, you may be able to go ahead and transfer and go somewhere else. One of the downsides of Trump's 2017 tax bill, we used to subsidize people moving for jobs. We gave people tax breaks for the cost of moving expenses to get to a new job. We no longer do that.
That probably made back more money in the higher taxes they paid than it cost us, but penny wise and pound foolish isn't unusual.
We didn't see it for a while now. We may be seeing some of the effects of people can't get to the jobs that are out there. Okay, budget deficit. This is a complicated thing. Let's look at the first half of this and ignore the bottom of the chart for the moment. We're going to the officially reported numbers. In fiscal years run October 1st to September 30th. So Trump budgeted fiscal years 2018 to 2021. His last 2 fiscal years, we'll see in a moment, had budget deficits around $3 trillion. Biden's first budget year, officially, we reported a budget deficit of just under 1.4 trillion, and we're forecasting a budget deficit this year of 1.7 trillion. And when you look at the numbers, that's mostly a function of revenues going down because the stock market went down in 2022. So we don't have a bunch of capital gains taxes in 2022. We're going to get some in 2023. Different people are going ahead. included in the 2022 budget deficit was 380 billion of that did not happen. And we were reversing that expense in 2023, 330 billion, because there are certain things that are going to are still included. The Biden administration went ahead and offered some new programs for student loan forgiveness. Some people, not me, like to go ahead and take these and remove them out of the years because we didn't give, so they want to say the budget deficit in 2022 was under $1 trillion, but we're never going to talk about that. We want to talk about the fact that the budget deficit in 2023 is going to be $2 trillion, so it's double. I don't think that's the right way to look at it, but a number of people are taking that look at it. We have to be prepared to, if you're going to talk about this being $2 trillion, you got to talk about the fact that we were under $1 trillion. And this is just looking at a partial year through August. Again, leaves out September. What we see is that basically outlays or spending between the 2 years pretty darn close. 5.4 trillion to 5.5 trillion, 100 billion higher and 41 billion higher. But the big difference is that we've got a drop in receipts. The stock market didn't go up. We didn't have capital gains to the same extent. Now this graph goes ahead and shows if you adjust the number, so you have a big drop in Biden's first year and then a doubling in his second year. That's not my way to look at it, but a number of people are proposing that that's the right way to look at it. Again, the big difference here is not spending, it's tax revenue going down. And the national debt burden under the Biden administration, but it may be starting to go back up if so this is a function of the total debt and the size of the economy, the size of GDP, which crashed during this, couple of negative quarters here, and we've had positive GDP growth. And this one looks like one of the things that's helped the economy and the deficit is that when we passed the Affordable Care Act back in 2010, we kind of capped spending for Medicare Advantage plans. And so Medicare costs per recipient which had been growing substantially, is flat. Now, there's a number of things that's happened. We had some breakthroughs in terms of drugs for cholesterol and blood pressure medications, which has helped contribute to fewer heart attacks and strokes. Haven't developed as many blockbuster treatments recently. The big new class of drugs are the anti-obesity drugs, which are diabetes drugs that have been found to contribute to weight loss. Medicare recipients can get them if they have diabetes, but Medicare will not cover anti-obesity drugs, although it will cover, surgery and various other things to help weight loss. So it's just an odd thing that they won't cover the anti-obesity drugs.
Isn't there a supply issue at the moment anyway? So if they covered it, there would be a problem. We couldn't make enough?
I don't know, because if they were covering it, I don't know that it would take that long for manufacturers to increase their supplies.
And this was the number one risk factor that the CBO and others had for the deficit over the long run, was this Medicare per person or healthcare spending per person figure. And so if this is really changed, if this is sustainable, then it's going to be a huge win for the long-term budget deficit. But we'll see. And I'm not sure how much the CBO has changed their assumptions about that, if they are currently expecting these to go up again or not. I've got to take a look at that.
It's also, what's the Medicare actuary doing with it as far as when we're going to exhaust the Medicare trust fund? This is the 1 month, month-by-month percent change in the CPI, which jumped up this past month due to a surge in gas prices. Expecting you to keep talking.
I can talk to it. Okay. So when you look at the contributing factors, it is exactly what Carl said. It's energy and housing as usual. And that accounted for almost all of it. So this was, we've been talking about the battle between gas prices and shelter rent. And this is one where the gas prices have just jumped and it's really moved it. Go to the next one. So there was good, it was a tale of two stories here. One is the core inflation, which is the one that the Fed worries about more, kept falling and fell quite a bit, actually. That's because rent inflation has been slowing and energy is not in the red line. The energy, the core excludes food and energy. And so that number has been falling. That's very good news. The number that bumped up, though, is the all items, which includes those energy prices. And again, the last slide was the month of August versus July. This one is versus a year earlier. So this is August of 23 versus August of 2022. And good news on the red line, bad news on the blue line. And this, the far right column analyzes the 12-month change. Everything else is the month-over-month change. And so I highlighted in red here the energy piece. You can see the big jump in energy costs, not just gasoline, but it was all of them, the fuel, oil, energy services, energy commodities, all of them jumped. So they're red in August, which was that 0.6 jump, but they're green versus a year earlier. They've fallen from where they were a year ago. So kind of a dichotomy there, very different result when you look at the different time periods. And then down lower, when you're looking at the core, it's not as obvious what's driving things, but it's really that shelter row, which is weighed very heavily in the number. And you've got these crazy transportation services cost increases, rental cars, insurance, car repair, they're all through the roof. That's not as weighted as heavily, but it's very large increases in what's happening there. Let's keep going.
I would just point out that natural gas prices have not gone up a lot. And so we're not seeing a big increase in the price of piped gas. Let's hope that shows up in people's gas bill this winter.
Yeah. All right. And looking at inflation by itself, that's the cost side. People have got to think about the income side with wages. And that's a good news story for the production workers, which are about 80% of the private sector workers. The wages are grown faster than inflation. The hourly wages are up of almost 21% since the pandemic, starting here from February 2020, because that is the pre-pandemic peak. That was a very good month before the pandemic, the last of the really good months before the pandemic started hitting. So it's a fair measure of where things were before the pandemic, and up 21%, CPI all plus 18, the CPI core plus 16. So wages are comfortably ahead of that core measure, even though you don't hear about this in the news very much because people focus on the inflation numbers and how it's filling everybody's pocketbook. On average, that's just not true. Wages are ahead of inflation and have been throughout the whole period. You can see the blue line is always above the red and the green lines here.
As we talked about early in the pandemic, we lost a bunch of low wage jobs. So the average wage grew significantly, and then it shrunk, and then it's been growing as those lower wage jobs have come back in the economy.
And you look at the long view, go all the way back to 1964, real wages, so these are inflation adjusted wages, they are extremely high historically, 96th percentile, $29 an hour in 2023 dollars versus, and you can see the other numbers that are here, they're higher than that big peak in the early 70s. And they're above that 95th percentile line, which was 2883. That's why they're 96th percentile. Very strong real wages compared to our history. Also, the media tends to focus, if you look in that upper right-hand corner, they focus on that drop in real wages in that period, and they've been coming up in the last year or so. But in that, the impression was put in people's brains of, oh, real wages are falling, it's the end of the world. And they didn't explain, A, that spike was unsustainable, B, we're ahead of 2019, and C, these are incredibly high wages. They just ignore all the points that matter and just point to that little, oh no, it's falling slightly, it's the end of the world. It's very, very difficult to overcome that, but this is what this chart is telling you is extremely high historically, 96th percentile, that we're above the 2019 pre-pandemic level, that spike up was a phony spike, and we're in great shape. In fact, didn't include it in this meeting, but we shared it in prior meetings. Under Biden, if you take the average of his tenure, he has higher real wages than any other president that's measured in this time frame back to 1964. I have yet to see the media headline with that in there, but it is the truth. And that is these numbers, even with that drop off there, because Trump, you see, look at Trump numbers going back, they're going, much lower than where they are now, back down into that where Carl's showing you there. Throughout Biden's time, they've always been higher than most of the Trump years. So it's he's the champ. Trump is in second place, and it's about $1 difference, like 90 cents an hour difference or so. And then I think he's $4. Biden is $4 ahead of Reagan. St. Reagan had pretty low real wages. As you look here in the 80s, you'll see that those are nothing compared to where they are now. But back then everybody loved the economy. It's all about salesmanship and the media helping out. But that's the good news story. Can't have to beat a graph like this in terms of how good things are from a real wage perspective.
Well, we basically see that we had, an upward trend in real wages coming out of the Great Reset. Well, actually, kind of an artificial downward trend at the start of the post-Great Recession, and then it was going up. And the pre-pandemic trend, we're really back on the line with the pre-pandemic trend. If you take out the eliminating the low wage jobs, so we up the average for the hire temporarily until those people get rehired.
Good news story there that is totally unheard of in the media. They don't talk about it. It's a secret, carefully guarded media secret. Keep going.
Question for you, David, on this graph. I'm not doubting these numbers because I know where they come from. But why is the perception so much different in America today? 70% of people are saying that the economy is just not keeping up. They're being killed with inflation. Is the term on that chart average? Is that the key? That not everybody is seeing this? It's just those that are getting new jobs, or just the UPS workers with their 48% increase?
Now, you could have some distortion because it's an average and not a median. However, the chart that I'm showing there is the real wages for the production and non-supervisory workers, which are not the management. So that is not the high wage earner who can handle inflation better anyway, right? So it's that bottom 80%. So I'm taking out the high end average part of it. And also when you look at the real median wage, which has the chart we're showing there is dollars per hour. When you multiply that times the number of hours people are working, so the actual wage, the check that they're getting, that is following a similar pattern. It isn't that this isn't a complete outlier and everybody else has got a different story. And this is sort of the central issue, I think, of the economy right now. And we'll show you some other slides as we go about this. But I think Paul Krugman made a really essential point this past week. And I shared it on Twitter, and I think he was interviewed by, was it Christian Amanpour? And he said this, and it's a really critical point. He said, no matter how much people complain about the economy, they are spending like it's a boom. Their behavior is boom behavior. In other words, consumers are not retrenching, saying my situation stinks, I am not going to spend money. They are spending. And it's not just rich people spending, because that isn't going to drive the entire economy. It's everybody. So on average, so it's people spending like it's a boom. And I think that is so much more important than how they feel today. And you'll see, and you've seen this, I know you know the answer to this one, Bill. I mean, if you look at charts of sentiment going into election, when Trump was president, Republican sentiment was high and Democratic sentiment was lower. And then when the election happened and Biden won, it switched. Democrat sentiment jumped, Republican sentiment dove. So there's a partisan aspect of it. And as we've been talking about, the media has been horrible in explaining this economy. All they talk about is inflation. I can't even find an article on the New York Times that goes through and lists all the awesome things that are happening under the Biden administration. I have begged them to do it. Krugman is the closest I've seen. It's really difficult to get through the noise on inflation, and they just don't want to cover it. And it's really, so we'll cover this some more but there's a lot of factors, but I'm going to show you the data is clearly that the economy is booming, but the sentiment is incredibly low considering how good the economy is. And we'll share some more on this in a little bit, but so let me pause there.
Yeah, I think you just answered the question as to, because I hear people say, I don't care what you say about the economy. I just don't have any money left at the end of the month. Well, that could be because they're spending like it's a boom economy. They haven't pulled back at all. And they're
yeah, and maybe they could pull back a little bit. Yeah, what did you get? That example of the 7 televisions was a good one earlier. It's like, hey, I've got 7 TVs and 4 cars in the driveway. It's like, well, yeah, dude, you're doing all right. So it's really, there's a very big disconnect. And Krugman is on the case, like he's trying to figure it out. It's not like there's a definitive answer to your question, Bill. It's sort of the central question that economists are asking is, why do people hate this economy so much? And the answer is probably inflation. They just hate inflation with a passion. It doesn't matter what the other data is telling them and how they're spending or behaving, but you act like it's a boom. We're going to tell you it's a boom. Okay, so misery index is the sum of inflation and unemployment, and right now that sum, as of July, so we have one more month of data. This chart is a month out of date, but it's not going to be all that different. It's a little higher, but still, misery index of 6.8. So that is 3.8%. What is it? I think it was 3.8. No, where was it? 3.5 unemployment and 4.2 inflation, I think is where that one came from, but it's 6.8. That is about 75th percentile, 74th percentile. Historically, that's a very good combination. It is better than any point during the Reagan administration. Reagan never had a misery index this good. Yet, Reagan's sentiment during this time was like 80th or 90th percentile. He had like the best consumer sentiment ever. People thought the economy was awesome, morning in America. But the measure is actually better now than it was ever under Reagan. And the 95th percentile, just so you know where it is about 5.1. It actually hit the record low under Obama. And it was also very good throughout the Trump administration. And it's higher now, a little toward the top end of that with Biden. And coming down, as you can see, drastically. So we'll see where Biden ends up. But right now, this is a very good misery index historically. And, worthy of the horrible sentiment that we have in the economy. All right, let's keep going. So let me jump ahead a second to something. Just do this one real quick. We were talking about this in the beginning of the session, and I just threw this together early on. The crude oil production right now is higher on average daily. These are daily averages, higher than it was in 2019 at the peak. That was the prior record. And through June of this year, we're running higher production than back then. Now, as a progressive, I wish we weren't. I wish we were getting to clean energy and all that. But if you're talking about gas prices, this is the chart that Carl was showing, the table, and I just put it into a graphic format, just averaging the months for each of those years. So there we go. We'll come back to that stuff. Now, where is the sentiment one is the one I wanted to get to. Here we go. This gets back to Bill's question. So the Economist did a really interesting article here. And they put together a statistical model. They took 13 different variables, and they said, and they found that they could, with those 13 variables, they could track the sentiment score, the Michigan sentiment score that's always in the news. That's the actual sentiment score, is this light blue line. And their model can track it from 1980 to 2016. They were able to track it really well. And then look at this big difference now. So actual economic results were predicting the sentiment score very well for most of this history, 1980 to 2016. And then this giant difference appeared. And sentiment hit the lowest ever, even though it was predicted to be up here based on the economic situation. I mean, we're better now, but for a while we had like great recession sentiment. It can make some sense during the pandemic, but not in 2022. It might have made, I'm sorry, yeah, this is the bottom of the pandemic, sorry, and it was back down there again down here in like 2021, 2022, somewhere in the middle of 2022, it was the lowest ever, below Great Recession level when you had high unemployment and just misery. I mean, it's a crazy number. And so this is why Krugman's point of, and let me show that slide here. This slide shows correlation with spending. So they took the same 13 variables they used on the other slide, and they said, these 13 measures predict spending very well. They do track with spending very well, but they don't track with sentiment anymore. And they track for a while pretty well, but then they don't track it anymore. So these 13 measures that we saw here are the same 13 they're using here, and they're still tracking the spend. They're tracking the quality of the economy, but not sentiment anymore. Sentiment has just diverged. And, it's a mystery exactly why that is. It's just the hatred of inflation is probably the best hypothesis. But, are people angry about COVID? That was something that one economist was writing about, that they haven't really, that it's COVID that's really caused the split. I don't see that in the media enough, but that was a pretty credible economist view of what had happened, tried to eliminate some of the other variables. This economist article is a really good one. If you can see it, I'd recommend it. If you're not blocked when you try to see it, but I've excerpted some of the stuff here. People are behaving like this is a strong economy, consistent with that model. They're just not talking about it that way. All right, let me go back to the top of this section. So I think we talked about this in a prior meeting, the CBO's forecast. When you look at this big increase, you're going to see a big increase in unemployment. They think up to 4.5 and then peaking at 4.7 in the fourth quarter of 2024. They're thinking of like a possible 2024 recession, and they're expecting payroll employment, the job creation, to actually go negative. Meaning they think it's going to be about 205,000 in 2023, which is about right. That's, Carl showed you a slide that said the last 3 months have been about 150,000. We showed you another slide that says it's been like 286,000 since June 2022, when we regained the pandemic peak. They're saying it's going to go negative in 2024 and flat in 2025. So this looks a lot like a recession. So that's what the CBO has. Remember, a recession doesn't have to be a really deep or bad recession, right? It just means the economy has peaked and is going to come off that peak, hopefully not far from that peak. We shall see. Notice they're not predicting that this is minus 500, or what was it, Carl, like minus 700,000 or 800,000 jobs a month when we were at the beginning, or the Great Recession when Obama took over. It was like 700,000 or 800,000 a month. That's not what this is.
We were losing 700,000 to 800,000 jobs a month.
Yeah, I mean, they're not predicting anything like that. They're saying we're going to peak and probably come off that peak a ways. Each 1% of unemployment is about 1.6 million jobs. We've got about 1.6 million. Sorry, we've got about 160 million in the labor force. So this, or closer to, was it 166? So maybe it's 1.7 million jobs. If you go from where we are now, around 3.8 to 4.7, you're looking at putting 1 million or 1.7 million people out of a job. Hopefully we can avoid that. Currently, there are these 6 key measures that the National Bureau of Economic Research uses to declare when you've hit a peak. And so you would expect to see these lines showing a peak and then dropping off. So they kind of do what this orange line, if you saw all the lines doing what this orange line did, you'd be able to kind of say, all right, there's a peak. But these numbers have continued to go up throughout 2023. This is indexed, meaning this number here, the green line, is the employment level. Let's use jobs. All employees, total non-farm. Red is about not 2% increase. It's about 1% increase this year. A little bit over 1%. It's growing. The only one that's negative is this real manufacturing and trade, which I had never seen anywhere else except this list of NBR statistics. Nobody covers it that I'm aware of. Maybe in certain industries they really look at it. I've never seen it, but otherwise all of them are up, and that tells you we're not at a peak yet. When you look at the Federal Reserve Bank of New York, they do a prediction every month. They're saying 61% chance of a recession in the next year, and they do their analysis based on the Treasury rates, which are very weird because you've had this giant increase in the short-term rates. That's the number the Fed modifies. They've raised that to 5%. but people don't believe in the long run that we're going to have a lot of inflation. And so the long-term rates have not changed. It's not easy just because the 5%, you could get 5% on your money market account or maybe some savings deposits. They're not offering you 10% on a muni bond or 10% on the federal bonds. They're just they're the same or lower. And that's why you have this recessionary, that's a recessionary relationship when the long term and the short term are very close, but that's not necessarily what's happening here. This number actually fell a little bit from last month. It was 66. Last month it came down a little bit and it had been rising up to that point. So it's hard to see it here, but it's this bend. That recessionary probability has peaked and is coming down a little bit. Goldman Sachs was talking about it, and I think someone might correct me here, but I think their number was, is it 15% or 25% chance of a recession in the next year? I mean, Goldman doesn't think we're going into recession in the next year. So we'll see, but this one's fairly high, but coming down. Now, we got some really good reports that I recommend you guys read, and they are not necessarily good news. Some of it's good news, some of it isn't. These are the annual reports that the Census Bureau does. And so these are annual statistics through 2022. They always come out like a year late. So we just got them in September, but they're for 2022. And what we see here is the real median household income. So real meaning inflation adjusted household for the entire household. It had peaked in 2019 and it's been falling for the last 3 years. And it's 2.3% down from last year and 4.7% down from the peak in 2019. So this is a pro-Trump statistic here. One thing that happened,
ignore the fact that it started to fall under Trump.
Yes, that's true. It did in 2020. That is true, but that trend has continued. That's a good point, Carl. I'll keep that in mind when I start fighting with people over it, because we will. Now, there's an interesting stat in here, though. The number of households increased by 2 million, or 1.5%. It's the biggest percent jump since 2011. It's biggest percent or numeric jump since 2011. Now, that is the denominator in this equation, right? It's a real median income total divided by the number of households. So the number of households jumped a lot. And when you do the math here, if you figure 1.5% here, 2.3% drop, that means the income was down about 0.8 and the household part was down 1.5. So this is almost 2/3 of the reason for the drop was the number of households, which isn't necessarily a bad thing that you've got more households. And this may also get at part of the reasons why we've got housing inflation, is because the giant increase in the number of households that are forming, and I don't know all the demographic reasons behind that. I'm guessing it's got to be, what is it? Is it Gen X is the old people like me now, right? So what's is it the millennials are the one after that? They must be getting houses, moving out from mom's basement. So as the saying goes, so this is, just keep that in mind, is that yes, this statistic doesn't look good. You want it to go up, no doubt about it. But a big chunk of it was household formation this year, which is kind of interesting that's happening, and may be part of, again, why we have the inflation in the rent in the house.
Just as a comment, I
go ahead.
don't know where the household formation is coming from. Is it people being able to buy their first house, get their first apartment? Or is it the former Senator McCain not knowing how many houses they owned?
It is probably not the latter, although I give extra credit for humor in economics. It's rare when you can find it. No.
Well, I do know that people are buying multiple houses.
It's renters and homeowners both. It's not just one or the other. But to the answer to the question, I don't know what share of it is people buying houses versus people renting. But this is a Fred statistic. Fred also has the total number of households. You can look it up, and I looked it up to see what had happened underneath this number. Now, it's not a perfect apples to apples analysis, because this is not a real average household income. This is real median income. So it's not a perfect analysis that I did, but I know that the number of households jumped by 2 million. What I don't know is what is the exact amount of the total income, because I multiplied the median income by the number of households. Or I divided this, I multiplied this real median household number, like the 78,250, times that number of households to see the total income figure. Again, I don't want to bore you with the details. A lot of this drop, household formation. So just keep that in mind. It's not all income.
Okay, Bill has his
All right.
hand raised, so what's your
Oh,
question?
go ahead, Bill. I couldn't see it. Go for
Yeah, so we looked at a chart that has said that we have grown the job markets since 2020 nicely, with more people working than ever. We have a chart that says that real wages have grown like 20%. So if I was to take the number of people that are working and multiply that times the wage, one would think that that the tail end of this chart would be just reversed.
I don't know. I've got to dig into it some more. I have to go through the report in detail to understand these numbers better. That's a great question. You would think that, right? That this number would be up. And I don't know why it isn't.
People
and
are
real
getting
median
apartments,
household
they're not getting roommates.
Well,
That's
know.
one thing that will do it. And the other thing that'll do it is if the McCains buy another 6 houses.
and realistically, maybe this chart explains the question we were asking earlier to some extent.
Why are people upset? Because their real median income is down. That's fair. Yeah.
Well, no, their median household income, their individual incomes might be up, but if more of them are supporting households, the households are smaller. I don't know what it could leave them feeling more stretched. It is the case that at least it's generally considered to be the case that a couple can live more frugally than two singles in their own households.
Yeah.
Yeah, we'll take that as a to-do item. Let's dig into understanding why, and it's probably buried in that report of what exactly they're going on, because it doesn't make sense with some of the other stats we're seeing. And the CBO had some data too that we shared a few months ago. They did the analysis in the later part of 2022, and they were forecasting 2020, and they were saying that incomes were up for most groups. So I am curious to see what that is, and I'll dig that analysis out as well, kind of for comparison. But this is an important statistic. It's a big one, and it is not pro Biden. It's a pro Trump stat with Carl's caveat of it was falling in 2020.
It was falling. It was falling between 2019 and 2020, and it was falling between 2020 and 2021. So it's falling under 2 years under Trump.
Okay. I was thinking just one, but you're right. It is both years. I think he's going to get a mulligan in his pandemic year, but you're right. It falls twice. And that's right. Good point. All right. So more to come. We got to analyze this one some more, right? This is a head scratcher. The headlines.
Maybe the key is the word medium, and the other key is household. We have to define both of those when you look at it for next week, next month.
All right. No, yeah. We'll dig into this one. Now, the official poverty rate actually improved in 2022, but that's not what you saw in the headlines. They were talking about this supplemental poverty rate, and this was the rate that was affected by the child tax credit and the earned income tax credit, which had been expanded as part of the pandemic measures, and those expired, I think, at the end of 21. And so that caused that special poverty rate to jump significantly. Inflation had something to do with it too. Things got more expensive, but this take away income at expense, and so you see a big jump in the poverty rate. So they went different directions. The official poverty rate went down last year. It improved. The supplemental rate jumped. And I was looking at the methodology behind them, and maybe we dig into this one a little bit too. Maybe we give these reports some extra analysis in our next meeting. But there are a lot of differences between that supplemental poverty rate and the official rate. It's not just like one thing, like these special child tax credit, and it's not just pandemic measures. They've been using the supplemental poverty rate for some years. Goes back about 10 or 12 years, I think. And we'll dig into that one a little too. But all the headlines showed is, it's the end of the world. The poverty rate's jumping, and Republicans are laughing at Biden. And it's like, dude, you guys are the ones that made it clear you would never support an expansion of the child tax credit and the earned income tax credit. Democrats didn't even bother bringing it to legislation. Maybe we should have, but that wasn't, it's the block was on the Republican side. That is what guaranteed this goes from 7.8 to 12.4. And, by not bringing it to legislation and letting Republicans vote against it, we we opened ourselves up to that. We probably should have. But, maybe we didn't even have the Democratic votes to do it. I'm sure Sinema and Cinemanchin would have tried to block it as well. I don't know the details there. I'll look into that too. But in theory, we should have been able to push that. And we didn't from a legislative standpoint. But so a mix. Good news, official rate, bad news, supplemental rate. Good news, unequivocal good news on the number of uninsured. The statistics that are used by I like the CDC statistics better. It's the same trend that you see with the census statistics, but the numbers are a little bit different. But so I use the CDC numbers. I think they have a more comparable history, so they can go back a little further and better. But this is showing like a 5 million improvement in the number of uninsured since 2019. As you know, we had some sabotage of the ACA going on here, and then the pandemic hit, and there were, even under Trump, there were measures to help with the ACA and help with healthcare, and the number of uninsured has been dropping consistently. This number will probably pop back up in 2023 because of some of the Medicaid expansion pieces have expired, and so you're seeing people kicked off the Medicaid rolls. Another thing that we should have put to legislation, I think, but still a very big improvement through 2022. So you've got a bad trend here, a mixed trend here, good on official, bad on the special, and a good trend here. So those were the three main reports that came out of the census, I think last 10 days or so. And, we'll dig into this guy, see what
we need more time to understand.
Yeah, and these are big reports. And I was just happy to get some charts thrown together for him. So
I would suggest ignoring them for another month.
There you go. Let's do it. The investor inflation expectations are a really important thing that the Fed looks at. We always talk about this. Still, inflation expectations seem pretty controlled. They're still around 2.3% over the 5 and 10 year range, meaning people think the Fed's going to get this under control. If you were to see these numbers start to spike up, that would mean the Fed needs to do more. And remember, they've got two major tools. They can raise the federal funds rate, which is this interest rate here, which is now around 5.3, or they can reduce the size of their balance sheet, meaning they can sell bonds to take cash out of the economy. And they're doing that. And I think I shared the slide last month. Their balance sheet had shrunk about 10%. And so they're working on continuing to shrink that. And that's another way behind the scenes that they are tightening the economy. Point to make about this is that even if the Fed stopped raising rates, if inflation is coming down as it's been coming down, again, it didn't come down last month for the CPI all, it came down for the core with gas prices jumping. But if inflation is coming down and the inflation rate is constant, if the interest rate is constant and the inflation rate is coming down, the real rate of interest is going up, meaning the Fed is tightening, even though they're not doing anything. That gap between the Fed funds rate, the 5.3, and inflation is increasing. It's almost like they're raising the rate. So there's some tightening there. And again, they're tightening because they're reducing their balance sheet size. So don't assume that the Fed holding the interest rates constant is they're doing nothing. They're definitely doing something. Stock market, people love to talk about how awful their 401k is under Biden, blah, blah, blah. The stock market, the S&P 500 is up about 33% from Biden's election. It's up about 16% from inauguration. Trump also took credit for this from election. So Biden would not be out of the realm of reason to do it. And the stock market had peaked up at about 42% under Biden. I did a little analysis today, and this chart is not in the one we shared with you. I just put this in my version. The S&P 500, this is the annual average of the index. 2023 is the year-to-date number. The others are for the full year. But the S&P 500 is about 45% higher now than it was in 2019. And Republicans love 2019. They're like, this is the best economy ever. Trump was bragging about even 2018 being the best economy ever. And those were very good years. The S&P 500 is 45% higher than that. We talked about the oil production. We talked about these guys. But I think I snuck this one in just for fun. Which party has presided over the 115 million jobs created since 1945? Democrats were president for 83 million of those, 72%. Republicans for 32 million, 28%. And Republicans were actually in office for about 20 months more than the Democrats. So it's not because we were in office longer. The U.S. has experienced recessions in 50 quarters since 1949. Who was in charge? Democrats only 8 of those quarters, and Republicans for 42 of those quarters. And about 4 of those quarters were Obama, who inherited the Great Recession from Bush. So
Actually, it should have only been 1 quarter.
Wait a minute. Let's see. Is that right?
Well,
December,
it depends on how you counted it, but the first quarter of 2009 was a Bush quarter.
Okay. You're right. No, you're right.
And so
Obama started in January.
Really
Right, correct.
First
That's
quarter
correct.
2007 through the second quarter of 2009.
I stand corrected. I shouldn't add that anecdote because it's wrong. It is simply the 8 quarters of the recession, 42 under Republicans, 8 under Democrats. So, if you want your economy to be in recession, hire a Republican. They're good at it. 10 of the last 11 recessions started under Republicans. And notice when I say 10 of the last 11, that recession was Carter's. Biden has not had a recession. Republicans love to say he had a recession. No, the definition is not that you had 2 quarters that had negative growth. We had a couple quarters that were negative GDP growth. That does not a recession make in the United States. We have not had a recession under Biden. For a Democrat recession, you got to go back to Carter.
If you want a recession and elect a Republican president is true because, of course, forget the 10 out of the last 11. The last Republican president that didn't have a recession starting his watch was James Garfield, who served 6 months in 1881, before he was killed by an assassin's bullet.
Love it. He was an assassin that did not want a recession, that guy. He was very anti-recession. This is the slide that I was talking about that got almost 140,000 views on Twitter, thanks to some sharing by some high volume people. This compares the Trump 2019 statistics with Biden in 2023 so far, and this was through data as of September of 2023. So the real line, the facts are still true. They're just a month out of date. So I didn't update these were not updated at the time. They were not available at the time of this slide. I just left it as it was. So but in almost every statistic on here, Biden is better. I think, every statistic he's better on this chart. And these are not minor things. The unemployment rate, job creation, GDP per person, the employment to population ratio for the prime age workers, real wages, real net worth of a household, stock market, and the number of uninsured. All these things are important and all better in 2023 on average. And they are also better on average in 2022 in nearly all cases as well. There may be, I think this employment to population ratio is like a hair lower. It's like 79.9 or something. Otherwise, all of these are better under Biden. This one struck a chord for whatever reason. So you might want to share this one with your friends. And this one is updated, and this one shows, again, it picks 12 statistics, also pretty commonly reported. And on 9 of them, better than when Biden started, 11 of them better than pre-pandemic. And this one, though, is not annual averages. These are points in time. So these are as of February 20th, as of February 2020, if it's a monthly measure, or the fourth quarter of 19, if it's a quarterly measure. That is before the pandemic peak, that is before the pandemic hit. Those put Trump in a very favorable light. This is about as good as Trump was ever. And here's when Biden took over, and then here's where we are with the latest information. All good news. Generally, in most cases, you've got the real wage was a little bit higher when Biden first took over. But remember, that was that artificial spike. He inherited that to some extent. That's why that no is here. The unemployment rate, Trump had a really good February of 2020 was a really low month, 3.5. Biden has hit 3.4 twice, but the latest measure is 3.8. So he gets the no there. It's the only one. And we've got a couple other no's. The real net worth of some households, the real net worth stats had peaked about when Biden came in, or actually they peaked a little bit later, but inflation has taken some of that stuff down. So you got some no's here. But for the most part, better than 2019, not better than when Biden started. Some of that stock market, but it's housing, it's a blend of things, but a lot of it's just inflation. here are some places you can go to find some cool stuff. We've got this Wikipedia article that you can go to that it compares the Democrats and Republicans, so you can always get the statistics there. 2 different Wikipedia articles that are pretty handy. And you've got other citations here that you can go to for this. You'll see this New York Times article is, if people that actually read the New York Times, you can give this to them, talks about how much better the Democrats are. It's a couple of years out of date, but that doesn't change the trend. Biden only has expanded the Democratic difference in jobs, and most other measures are better under Biden. So the more Biden you put in, the better the Democrats look. All right, so that ends our regularly scheduled program.